Hello, I'm Barkley Roper with Tiger Capital Management, a registered investment advisor here in the state of Idaho. I've been in financial service for over a decade, and I hold a master's degree in finance along with certificates in personal financial planning and financial analysis. Today, the purpose of this primer or blog is to explain the weekly trend update and how that can be useful for you. I think the reason I started the trend update is because I found a lot of individuals, whether they had their 401k, their IRA, or just their personal brokerage account, they didn't have much direction, and they tended to adhere to a buy and hold strategy. But what seemed to happen is that buy and hold strategy turned into a buy and forget strategy. And the one thing we don't want to do in the market is to forget about the funds, the stocks, and so forth, those assets that we're holding, because when we're in a primary uptrend, everything's good and great and we're making money. But when the market reverses and we come into a bear market and the primary trend changes from up to down, we tend to lose a lot of money in a buy and hold strategy. And so famous early American stock trader Jesse Livermore said, there's only one side of the market, and it's not the bull side or the bear side, but the right side, close quote. And so what he's saying there is there are trends in the market. There are primary trends when the market is going up, we want to be invested. And when the market is going down, we want to move to another asset that's either going up or just move to cash and wait for that primary trend in that particular asset to resume its uptrend. First of all, I wanted to make sure it was clear that there are no perfect systems. There's no perfect trading strategy. Legendary commodities investor John W. Henry said, there is no holy grail. There is no perfect way to capture that move from $100 an ounce to $800 an ounce in gold, close quote. So what he's saying is there is no perfect strategy. It's not going to work 100% of the time. It's not going to be a magic formula. But I don't want you to be confused with what he said, that there's no holy grail. There's no perfect system, but there are good systems. Better to have a system in place than just to have no system at all. As I talked about with the buy and hold strategy, what happens is that most investors become apathetic to the down moves in the market, because we go through during a primary uptrend, which may last 2, 3, 4, or even longer in years. People start to think, the market's going to continue to go up. Mr. Hamilton said, no tree grows to the sky, which means that no trend will last forever. And during a long-term bull market, most people forget that, and they think that during the next market correction is a time to buy more, because the market will then just resume its up course and continue upward forever and ever. But that's not the case. As we've seen in 2000 and in 2007, the starts of two major bear markets. We need to remember that if we buy and hold and then it turns into buy and forget during a bear market, if we lose 10% of our value in our portfolio, it would take us roughly about 12% to regain what we lost. If we lose approximately 20% in our portfolio, it would take us roughly about 25% to regain what we've lost. But in a major bear market like we saw in 2000 and 2007, we had over a 50 and 57% decline in the market. And having said that, it would take over 100% or roughly 100% to make back what we've lost if we've lost 50% in the market. And so we have to, although there are going to be some minor or major corrections, maybe a 10% or a 20% correction during a primary uptrend or long-term uptrend, what we want to try to do is sidestep those major bear markets where we lose 50% or more in value. So having said that, I've found through my research and do believe that trends do exist. Although the length and magnitude of the trend is unknown, trends do exist, and there are clues that appear that help us understand that a trend may be starting, and it's a good time to either get into the market or to exit the market using a long-term trend following system. I guess just a little bit about long-term versus short-term trend following system. In this case, what we're using is a moving average, a long-term moving average, which takes the prices of the previous closing prices during the past, if it's a 50-day moving average, it's taking today's close and the last 50 days prices, and it's adding those all up, dividing by 50, and giving an average of that price. And what we're saying is that if today's closing price stays above that average, then we're in an uptrend. If today's price closes below that average, then we're in a downtrend. Now, using a short-term trend following system, for instance, maybe a 10-day moving average, what are the pros and cons to that? The pros would be that we're entering and exiting the market faster, which means that we'll get out closer to the top, we'll get in closer to the bottom. What are the cons? Well, there's going to be a lot of noise or price volatility and movement that we're going to have a lot more entry and exit signals. Using a long-term trend following strategy like we are here in the weekly trend update, for example, using the 200-day moving average, what we're going to find is we're not going to have as many entry and exit signals. We are going to have to sit through more interim volatility for short-term or mid-term market corrections of, say, 10 or 20%. But what I found for the individual is, in order to stick to a strategy, is that it's as simple as possible, and that they don't have to make a lot of decisions. If we were getting in and out of the market on a monthly or even a weekly basis, it would be hard to stick with that strategy. And I found using a longer term trend following strategy, it's easier to stick to the strategy. And that's one of the reasons why I've chosen to use this strategy. This system has a mechanism which should preserve capital by letting your winners run and cutting your losses short. While cutting your losses short doesn't directly make you more money, indirectly it does, because you'll have more money to deploy at the bottom of the market when the bull market resumes than you would if you were to just buy and hold and let the value of your capital decline, for example, by 50%. And so indirectly, this system should hopefully lower volatility in your portfolio, which means volatility is the up and down movement, so it should be smoother, and it should also increase your overall return during a full market cycle. Full market cycle could be anywhere from 5 to 10 years, depending on the price movement and what's been going on. So, how this system particularly works. You should remember that there could be multiple variations of this system, and each one of those variations could work better or worse during a specific market cycle. And what do I mean by that? Is there anything magical about the 200-day moving average? No, there's not. What if you used a 240-day moving average or a 180-day moving average? What would it look like then? Would you get something similar, something close? You probably would. And so there's nothing magical about the 200-day moving average, although it is widely used, widely recognized, and it serves as a point of reference. And so I've decided to use that as the point of reference for the weekly trend update. I've also added what's called a 50-day moving average. And so what we're using is a 50-day, 200-day moving, what we're using is a 50-200-day moving average crossover. And I'm using the 50-day moving average to take out some of the noise. What will have happen occasionally is that the price will fall below the 200-day moving average and then quickly regain and go above that 200-day moving average. And the 50-day moving average keeps us from exiting the market right when the price falls below the 200-day moving average, hopefully keeping us from making a false positive call as far as the direction of the market trend. Let's see. Also, with the weekly trend update, what I've tried to do is create a balanced portfolio. And so what we look at are U.S. stocks, foreign stocks, real estate investment trusts, commodities, and bonds. And so when you're looking at the trend update and you said, well, if I want to emulate what the trend update is doing, what would I need to do? And what we're looking at is an equally weighted portfolio of those 5 major asset classes. So what does that mean? So if we have our portfolio total equals 100%, and we have 5 different asset classes, that means that 20% of our capital would be allocated to each of those asset classes. So we would have 20% in U.S. stocks, foreign stocks, commodities, real estate investment trusts, and bonds to make up the total portfolio, or 100%. We'd also want to rebalance that to keep that portfolio equally weighted. Probably want to rebalance at least annually, possibly no more than monthly, depending on how often you'd want to rebalance. Over a long-term, over a full market cycle, using this strategy with the 5 major asset classes, we should get equity-like returns with bond-like volatility. And so for the average individual, if you were to ask me, would this portfolio work for me? If you were following the strategy, I would say most likely it would. It would fit your needs and have a mechanism there to pull the cash to preserve your capital. So what you're going to do is, as you're following the trend update on a weekly basis, and we're looking at the charts, each of those assets, so those 5 assets that we talked about, you would want to be invested in those if we're in a confirmed uptrend. If we're in a confirmed downtrend, then you would want to liquidate that position and move that portion of the money to cash. Or if you hadn't invested at that point, you would just wanted to keep that portion in cash. For example, currently we're in a long-term uptrend for U.S. stocks, and so you would want to be invested in U.S. stocks. As opposed to bonds. Currently, bonds are in a long-term downtrend. And so if we had been in bonds a few months ago when the trend changed, we would have wanted to exit and move that portion to cash. Now we'll still watch bonds, and when bonds turn back to an uptrend, resume their uptrend, then we'll take that portion in cash and purchase bonds and stay with the trend until it turns into a downtrend. Now what I'd like to do is actually show you some charts. I'm going to start out with a long-term chart. We're going to look at the S&P 500 over the last 20 years, just to give you a glimpse, a macro view of what we're trying to do. And then we'll take more of a micro view and just look at the last year or two of the S&P 500 and some of the other ETFs or asset classes that we're tracking. So let's go ahead and look at the chart. And right now we're looking at the S&P 500, which the S&P 500 index represents the 500 largest companies in the U.S. And so this index tracks those 500 largest companies. Occasionally they get switched out, new companies get in, but there's roughly 500 companies that are represented. Gives us an idea of what the market is doing for U.S. stocks. Here on this chart, we can see that this chart's the last 20 years goes back to 93 all the way up to present day. We can see here is roughly where we are today. What I wanted to look at and have you look at is to get an idea of a trend and a long-term trend. We can see that toward the 95, toward 1995, we resumed and we were in a long-term uptrend. Price stayed above this blue line. Now this blue line represents, in this case, it's the 10-month moving average. The 10-month moving average, which is the equivalent of the 200-day moving average. And so these are the monthly prices, but we can see that the monthly prices for the most part during from 95 until about 98 stayed above that line. And so we had a good 4 years where we were long or invested in the S&P 500. We can see here that the S&P 500 price fell below the 200-day moving average. This is an example of where, when I say no system is perfect, we would have probably exited the market somewhere around here. And that would have been a false positive. But the nice thing about this system is we stay with the winners as long as we can, and we cut our losses short. We would have cut our losses short here, but the uptrend resumed, and so we would have quickly re-entered the market to continue with the uptrend up till the top of the tech bubble here in 2000, and probably stayed with it and would have exited somewhere toward the top. Once again, we're not going to get out at the very top because this is a trend following system. We don't know what's happening until after it's happened, but when we do register that something has changed, we do exit to preserve capital. And although we might have lost maybe 10 or 20% from the top, and when we exited, we would have preserved the capital while the rest of the S&P 500 continued to fall and have a total from the top to the bottom, a 50% decline in value. The trend following system would have then not gotten in right at the very bottom, but right about there, we would have re-entered the market, and during 2003 all the way through 2007 with very few market exits, we would have stayed with that primary trend, that uptrend, until the market fell below the 200-day moving average, or excuse me, the 10-month moving average in this case. We would have exited and sidestepped the majority of that bear market in 2008, which declined 57%. We would have then re-entered the market and probably gotten out of the market here, then re-entered, gotten out of the market here, and then re-entered until today, as we can see, and we'll look right now, that we are in a continued uptrend with U.S. stocks. So let's go ahead and look at that micro view. We'll go look at the last few years. Just need to change this here. So here we're looking at one of the 5 assets that we look at every week. Here's the S&P 500 represented by the ETF SPY. And here what we're doing is we're looking at this blue line represents the 200-day moving average. This graph is showing us the last 2 years worth of price movements. And this red line, this represents the 50-day moving average. And what I'd like to show you here real quickly is you see how the price fell below the 200-day moving average. Well, the 50-day moving average still was above the 200, and so we didn't look at that as a signal to exit the market. That took out some of the noise, which helped us hold on to that position without exiting and then having to re-enter. And so that's one of the reasons I've chosen to use the 50-day moving average in this situation. If we go on and we look at foreign stocks, we see that foreign stocks, the price is above the 50-day moving average and also well above the 200-day moving average. Real estate investment trusts, also we can see, here's a good point to make, is that we had a sharp decline in the real estate investment trust ETF. You can see that within a few weeks it had a a very large decline. Sometimes when we have a large drop off like that, prices rebound rather quickly. Although we don't know what is going to happen, sometimes I'll look for a point of support. A support area is where price has hit the bottom and has held above. And we can see that the support area in this real estate investment trust has been hit once, twice, 3 times, and possibly we'll see if it will hold above over the next few weeks. If it drops below that point of support, then I would call this a confirmed downtrend. We can see that the 50-day moving average crossed below the 200-day moving average, which is typically a time when I would call a downtrend. But we could see that right when it crossed over, it was right down here at that support area. And so I wanted to hold on to it to see if it broke below that support area or stayed above it. So far, it has stayed above that, and so that confirmed uptrend has continued until proven otherwise, until it breaks below the support area. Once again, support area is not it's not an exact science, but it's an area, a rough area of where price should stay above. Moving on to commodities. And in this commodities package, we have to understand that this particular ETF holds 3 major subgroups of assets. You have energy assets, you have precious metals such as gold and silver, you have agricultural commodities such as wheat and corn, and so this you need to realize that this commodity is a true basket of all those commodities. So if gold is going up and corn is going down, the commodities basket is going to kind of be flat if they were negatively correlated as far as those assets. But right now we can see that the price of commodities are below the 50, are below the 200, and that we had a crossover right here, which gave us a signal to exit commodities over the last few months. Bonds. Okay, and this represents, when I say bonds, this represents long-term, short-term, intermediate bonds. It's a basket of bonds, and we can see that also the 50 crossed over the 200 back up here, and that particular date was roughly at the first month of the year back in January when we would have exited bonds. And since then, we've had a decline, and price is now just coming up above the 50-day moving average, but is well below the 200-day moving average, and so we're in a confirmed downtrend with bonds. So this should give you a very basic idea as far as what a long-term trend following strategy should do, and how we follow it on the weekly trend update to hopefully guide you, whether you're in a 401k or an IRA, whether you're individually investing in your brokerage portfolio with an online discount broker. You can use this information to help you gauge whether you should be out of the market or in the market, in that particular asset or out of that particular asset, to hopefully preserve capital. Remember, Warren Buffett said rule number 1 said something like, rule number 1 to investing is never lose money. Rule number 2, don't forget rule number 1. And so we want to remember to preserve our capital. What I've also designed for those that might want a little bit more help or more in depth, like I talked about, maybe you want to be invested in not just a commodities basket, but you want to be invested in gold or oil, or instead of just a large cap U.S. stock fund or ETF like the S&P 500, maybe you want to be in small cap stocks or a particular segment, maybe pharmaceuticals or materials. Well, what I've put together is what's called the Trend Update ETF Investor Guide. And this guide is a monthly newsletter that you can refer to. And I follow along with kind of the rules and explanation of how that works. The meat and potatoes of this is this trend and rank table. And I follow 80 different ETFs, different asset classes like we just talked about, more specific than the 5 major asset classes that I follow in the weekly trend update. Here, what I do is I rank those from the best performing to the worst performing using a 1, 3, 6, 9, and 12 month rate of return average. And then I also indicate whether they're in an uptrend or a downtrend. And so you can use this guide to be in the best performing funds, and then also know if you need to move out of them and go to cash. It's something that could be useful for someone who is interested in creating a portfolio that has more than just the 5 major asset classes. If you have questions or comments regarding either the weekly trend update or the ETF Investor Guide, please feel free to give me a call or email me. I'd love to hear your questions or comments. I'm Barkley Roper with Tiger Capital Management, bringing you your weekly trend update, helping you stay on the right side of the market. Thanks, and I hope you enjoy it.